You're going to be in a lower tax bracket in retirement. That's a promise they made back in the 70s and the 80s when the 401k put the money in now.
It got me thinking here, as irritating as all those things are, what are the most irritating financial events or maybe even factors when it comes to retirement planning?
Well, I think the idea around it is the big surprises usually come in taxes. And the main reason is what were we told? You're going to be in a lower tax bracket in retirement. That's a promise they made back in the 70s and the 80s when the 401k put the money in now. We're going to give you a tax break for it now. We'll let it grow tax deferred. When you retire, you can take it out and you'll be in a lower tax bracket. Well, if you remember in the 70s and the 80s, the highest tax bracket was over 70%. And it was designed for wealthy business executives. But that's what we have now. I think some of the biggest surprises that we have, and I know the big, beautiful bill was just passed, but Social Security for a lot of people is not going to be tax-free, even with the big, beautiful bill. Because if your pension's income and all the deductions that you need to live your lifestyle, you still could pay up to 85% on Social Security tax. I think that's the biggest one that people have surprises with. And then when we start to get to required minimum distributions, it depends on your age, somewhere between 70 and a half and 74, but most of us out there, it's going to be 73, that you have to take money out of those traditional IRA accounts, 401ks, and 403bs. And that's, I think, when a lot of people hit that surprise is, wow, my pension and my Social Security kind of met my lifestyle. Now I have to take this money out of here. Remember, it's not a required minimum spend. It's a required minimum distribution. Congress just wants to get the dollars back. But the problem of it is with them kicking it up to the higher age, a lot of people that really don't want to take it are going to pass a tax time bomb onto their kids. Because when they extended that and took it from 70 and a half, they put in the rule that you only have 10 years to get it out of this tax-deferred asset when you're a non-spousal heir, with a few exceptions. So we have to look at that. Am I passing a tax time bomb onto my children? And I think when you start to look at that, if you've got more than $750,000 in your IRAs and 401ks, there's a pretty good chance that you're going to pass a tax time bomb onto their kids. That could create a tax time bomb when you're no longer here. Because I believe that reducing or eliminating taxes is the greatest thing you can do for a successful retirement.